Listen closely before we get into the details. I am not selling a course. I am not telling you to throw your money into any investments. And I am absolutely not taking a single dime out of your pocket. What you are about to hear is simply the most naked financial truth happening right now. You are looking at two parallel worlds existing on the exact same planet. On one side is the Shanghai exchange. Silver just opened at $99 an ounce. It shot straight up to a peak of $102. Before closing at $96, the final physical lot was settled at exactly the $102 mark. On the other side is the West, where the spot price of silver is still stuck and suppressed around the $86 mark. Stop for a second and think about that. That is a $10 difference for the exact same ounce of physical silver, a $10 premium. This is absolutely not a display error on your trading screen. This is the sound of a paper price structure fracturing and losing control against the real thirst for physical metal. In the next few minutes, we are going to unpack the most brutal data counting down from the COMEX exchange, the emergency purge happening on the Shanghai exchange, and the reason why massive capital flows from the East are quietly repricing the entire global precious metals market. This financial truth is not for the masses, but it is playing out right in front of our eyes. The Shanghai exchange just did something that the Western financial system always avoids talking about. Let us look at the exact anatomy of that chaotic trading session because it tells you everything you need to know about the real state of the global silver market. We are watching the paper illusion shatter. Silver opened at $99. It did not slowly climb to that level. It gap opened. The physical demand signal from the industrial buyers and recyclers was already screaming before the market even turned on. Bids were running $5 or more above the pre-holiday close. That is not market noise. That is the market violently signaling that physical metal is vanishing. Then the price pushed all the way to $102 per ounce. Imagine the sheer panic of the short sellers. Imagine the desperation of the massive industrial players who actually need this physical metal to build solar panels, electronics, and electric vehicles. These entities are not trading paper contracts to make a quick fiat currency profit. They are trying to secure vital raw materials to keep their production lines running, and they were completely willing to pay $102 to get their hands on it. The session ultimately closed at an average of $96. But here is the exact detail that matters most. The final physical lot reportedly cleared at $102. Whether you look at the average or that final transaction, the conclusion is absolutely inescapable. The physical price of silver in Asia is trading at a massive premium to the paper price in the West. That $10 premium above the $86 Western spot price is not an accident. It is a fundamental structural disconnect. Now, let us talk about why this is happening and what the Shanghai Futures Exchange did next. This is where the story gets incredibly real and highly uncomfortable for the paper manipulators. In the month of February alone, the exchange suspended 23 different trading accounts for breaching rules and attempting to manipulate the market. I will repeat that. 23 accounts suspended in a single month. We watched heavy manipulation attempts right at the open. It was completely visible. It was documented in real time by people tracking the order flow. The data showed clear and aggressive attempts to slam the price down and control the breakout. But unlike the Western exchanges where this exact type of behavior is often ignored or punished with a minor fine years later, the Shanghai exchange stepped in immediately. They cut the cord. They suspended the accounts involved. This is not some wild internet conspiracy theory. This is the exchange itself officially confirming that the manipulation was real enough to warrant direct and immediate action. To further cool down the panic, they raised the daily price limit to 20%. They increased the margin requirements to 22%. Listen to me very carefully. These are extreme emergency measures. You do not ever deploy emergency measures in a healthy and well-supplied market. You deploy them when the system is under extreme stress and the physical metal is violently bleeding out of your vaults. The numbers back this up completely. In the first 14 days of February, the silver inventory on the Shanghai exchange evaporated by over 40%. Over 226 tons of physical silver just disappeared from the exchange vaults, dropping the total down to roughly 318 tons. That is the absolute lowest level we have seen in nearly a decade. The metal is simply gone. Institutions, sovereign wealth funds, and massive industrial players are draining the exchange because they know the paper pricing game is nearing its end. They do not want paper promises. They do not want cash settlements. They want the physical bar in their direct possession. The 23 suspended accounts were likely trying to spoof the market, throw up fake sell walls, and shake out the weak retail hands so they could privately accumulate more physical metal before the real price discovery happens. But they got caught. When you have a $10 premium, evaporating inventories, and a major global exchange actively suspending traders for manipulation, you are looking at a classic supply shock playing out in real time. The Western financial media desperately wants you to believe that silver is just another volatile commodity. They want you to look at the COMEX price of $86 and think everything is completely normal. But absolutely nothing is normal. The Eastern buyers are calling the bluff. They are buying the physical metal, they are paying the massive premium, and they are demanding physical delivery right now. And every single ounce they take off the market is an ounce that can no longer be used to leverage hundreds of paper contracts in London or New York. The paper markets have relied on infinite supply illusions for decades. They print contracts, sell them into the market, and suppress the price to discourage you from holding real assets. But you cannot print physical silver. You cannot dig it out of a spreadsheet. It requires capital, labor, and energy to pull it out of the ground. And right now, the entities doing the actual manufacturing in the East realize that the West has been selling things they do not actually own. The 23 suspensions are just the surface level of a much deeper war for physical dominance. It is a wealth transfer of epic proportions, moving from those who hold paper derivatives to those who hold the tangible asset. Meanwhile, the countdown clock at the COMEX exchange in New York is aggressively ticking down, and the silence from the financial media is deafening. If you think the chaos is contained entirely to the Shanghai exchange, you are fundamentally misreading the global board. We need to look directly at the settlement picture, because this is exactly where the systemic pressure is most concentrated right now, and this is where the paper illusion faces its ultimate test of reality. The March open interest is currently sitting at an astonishing 188 million ounces of paper silver. Let that completely sink in for a moment. 188 million ounces of silver that supposedly exist in the form of digital contracts. All of those paper contracts are barreling towards settlement in a matter of days. The holders of those contracts have a decision to make. They can roll them over into the next month, or they can stand for physical delivery. Historically, the vast majority just roll them over and keep playing the paper game. But history is currently breaking down in front of us. Now look at the other side of the ledger. Look at the registered COMEX silver. You have to understand the difference between registered and eligible silver to understand the trap that has been set. Eligible silver is just metal sitting in a vault that meets the exchange standards, but it is owned by private parties who have no intention of selling it at these suppressed paper prices. It is off limits. Registered silver is the only category that matters. Registered silver is the metal that actually has a warrant attached to it. It is the metal that is fully available and legally obligated to be delivered to whoever holds the winning contract. That registered category currently sits at a mere 88 million ounces. Do the math on that structural deficit. That is more than 2 ounces of paper claims for every single ounce of deliverable physical silver actually sitting in the vault. And the clock is running out rapidly. We are heading straight into first notice day. From that specific point forward, the short sellers can begin issuing delivery notices. Any remaining long positions are at extreme risk of being assigned physical delivery. In a normal market, this is routine. In a market where the physical metal is bleeding out to the east, this is a recipe for an absolute system failure. Here is the most critical and honest read of the entire situation. The registered silver inventory has remained completely flat or slightly down in recent days. Absolutely no meaningful new physical metal is flowing into the COMEX vaults to replenish that critical registered category. Why would it? Why would any rational mining company or physical bullion dealer send their hard-mined silver to New York to get paid $86 when they can ship it to Asia and get paid $96 or even $102? The drain is a one-way street, and the paper exchanges are running out of physical ammunition to suppress the price. This structural crack is not just a theory. It is showing up clearly and violently in the options market. The COMEX implied volatility index for silver options has violently spiked to 134. Just weeks ago, when we were analyzing the initial breakout, it was hovering just under 100. Now it has blown past the extreme highs we saw during the massive January run-up. A reading of 134 is completely abnormal. It is unprecedented in recent history for a supposedly stable monetary metal. You need to understand what implied volatility actually represents. It is not just a number on a screen. It is the options market officially pricing in the immediate possibility of a disorderly and violent price explosion. The massive market makers and bullion banks who sell these options are not charities. They are looking at the data. They see the physical drain. And they are demanding massive premiums to ensure against a catastrophic price spike. The current paper price of $86 is completely ignoring the reality of the physical shortage. The paper price is suppressed, but the volatility index is absolutely screaming. Those two realities cannot exist in the same space indefinitely. Something is going to break, and it is not going to be the physical metal. And then you have the ultimate warning signal, flashing red across the trading desks of every major commodity firm in the world. The carry-adjusted basis between the March and May futures contracts. The informed minority of the market is watching like a hawk right now to see if the spread flips from contango into backwardation. You do not need a degree in finance to understand why this matters. In a normal and healthy market, the futures contracts further out in time always trade at a premium to the current spot price. This is called contango. It accounts for the cost of storing the metal in a vault and paying insurance and financing costs over time. But when that structure flips upside down, everything changes. When nearby silver suddenly trades at a premium to future silver, you have entered backwardation. And backwardation in a monetary metal sends only one completely terrifying message to the financial establishment. It means the market is saying, I do not care what your paper spreadsheet says, and I do not care what you promise to deliver me in 3 months. I need the physical silver in my hands right now today. It is the ultimate signal of physical market stress. It is the exact point where financial warfare becomes completely visible to anyone paying attention. We are teetering right on the edge of that flip. If that backwardation confirms, it changes the entire conversation from a trading opportunity to a systemic bank run on physical assets. But you cannot just look at silver in isolation to understand the magnitude of what is happening. Silver is just the highly conductive tip of the spear. You have to zoom out because the geopolitical and macroeconomic layer underneath this entire fiat system is catching fire simultaneously. Look directly at crude oil. It just surged to $67 a barrel. That is the highest level we have seen since last August, and the momentum is building rapidly. Bullish bets on oil are surging across the board. The Western media will blame this entirely on the escalating geopolitical risks surrounding Iran and the continuous instability in the Middle East. And while that geopolitical premium is absolutely real, they are actively ignoring the underlying mathematical truth. Global oil discoveries have plummeted by an astonishing 40% over the past decade. We have gone from finding an average of 10 billion barrels a year between 2015 and 2020 down to a mere 6 billion barrels a year in the current period. That is a massive structural supply deficit that cannot be fixed by printing more currency. It takes a 20-year lag time between discovering a new deep-water oil field and actually getting that first barrel of oil to the surface. When oil moves up on both structural supply shortages and immediate war fears simultaneously, it pours high-octane gasoline on the global inflation fire. Oil is the master commodity. It takes oil to mine the silver. It takes oil to transport the gold. When the energy input costs skyrocket, the entire baseline for precious metals is permanently revalued higher. And that brings us directly to the anchor of the entire global monetary system: gold. Spot gold is currently trading at an unbelievable $5,130 an ounce. Let that number register: $5,130. The mainstream financial media and the Western banking analysts are completely panicked by this reality. They do not have an economic framework that explains how gold can be trading at these levels while the stock market is supposedly fine, so they default to the only narrative they have left. They call it a speculative bubble. They call it a temporary excess driven by momentum traders. They tell their viewers to avoid it and buy tech stocks instead. They are completely and utterly wrong. They do not understand that this capital flow is not retail speculation on a Robinhood app. It is institutions. It is massive family offices. And most importantly, it is sovereign wealth buyers in Asia, making a quiet, deliberate, and permanent judgment about where real value resides. The import data out of India just confirmed yet another massive record month for gold demand. This is not an isolated data point or a holiday rush. It is part of a consistent, undeniable pattern. The physical demand from the East has been running at historically elevated levels for months on end. Anyone who actually takes the time to verify the World Gold Council data, anyone who tracks the Indian import numbers or the Chinese physical exchange flow data, understands exactly what is happening. The East is systematically draining the West of its tangible wealth, while the Western media continues to stare at paper charts and debate interest rate cuts. The mainstream narrative is still desperately looking for an explanation that fits their existing broken worldview, and they are missing the greatest structural shift in modern financial history. The silver premium in Shanghai closing at $96 while the West sits at $86. The massive COMEX implied volatility reading, the evaporating registered physical inventories, the looming threat of severe backwardation, the structural oil deficit, and gold securely breaking past $5,100. None of these are isolated events. They are perfectly connected symptoms of a fiat currency system that is rapidly losing the trust of the very producers who manufacture the physical goods the world actually needs. The paper construct that normally manages your perception of price and value is physically cracking under the sheer weight of real-world demand. The institutions buying at these levels are not trading for a 5% fiat gain next week. They are buying to protect their national sovereignty and their generational purchasing power for the next decade. They know that when the paper leverage finally unwinds, the only thing that will matter is who holds the actual physical asset and who is left holding a digital promise that cannot be fulfilled. The data we just walked through does not lie, and it does not care about your feelings. A $10 premium existing between the Eastern and Western physical silver markets is a massive structural anomaly that demands a resolution. There are only two ways this mathematical equation balances out in the end. Either the Western paper exchanges are forced to drastically raise their spot prices to stop the bleeding and keep the metal in their vaults, or the East will simply continue to exploit the arbitrage and take every last ounce of physical silver until the COMEX defaults on its delivery obligations. But before you rush out and make any decisions based on panic, you need to deeply understand the reality of the risk you are looking at. I told you earlier that the implied volatility index is sitting at 134. That number cuts both ways like a chainsaw. The exact same explosive potential that points to the upside can and will produce equally violent downside moves if the banking cartel coordinates a margin call cascade or a broader market sell-off to force retail liquidations. This is why you must separate what the data is actually saying from what you emotionally want it to say. That single distinction is where most people lose all their capital in this sector. This analysis is strictly for your financial education. It is not financial advice. Your job is to protect your capital and manage your emotions just as ruthlessly as you manage your positions. Do not take my word for any of this. Go verify the CME volatility data for yourself. Go look at the Shanghai exchange suspension reports. Do your own due diligence and invest with cold logic rather than internet hype. The ones who can read the data clearly and stay disciplined when the market gets loud are the ones who will still be standing when the fiat dust finally settles. If you want to stay ahead of the curve and keep tracking the real-time data of this physical wealth transfer as it unfolds, make sure you hit the subscribe button and turn on the notifications. You will want to be here for the next update because we are going to look at the exact banking entities that are quietly building massive short positions to try and survive the coming storm. Stay alert.